Man, welcome to Ken's Money Matters once again. We're back to the channel. If you are new, please consider subscribing if you like the content. And if you are a returning visitor, thank you so much for the support and welcome back. It's lockdown here in the UK, so I have been, focusing so much on traveling in the past, traveling and ensuring you can enjoy your life as you invest, as you make money and stuff like that. But now I'm back and I'm in the UK. I cannot travel, and therefore I'm going to focus on producing content that is focused on investing in the stock market, in the bond market, in the whatever way place you want to invest, especially Kenyans. So let's get this going, guys. In this particular video, we're going to look at the types of mutual funds we have in Kenya. What are some of the types of mutual funds? People here are talking about mutual funds all the time, but what are they and what types of mutual funds do we have and how can you eventually invest in them? Even though partly some of these things have been addressed in some of my videos, and I will leave links in the description below. Anyway, guys, let's kick in. So mutual fund is basically a group of investors who come together so as to invest in different investment options available to them. So for example, some people can come together, make a mutual fund and invest in equities, which are stocks, or some people call them shares. So that's also a mutual fund on its own. So basically a mutual fund is basically pooled resources that are invested in particular option. Number one and the most popular one is the money market funds. Now, this is most popular because a lot of people are risk averse and therefore they want to invest in things that they believe will not lose money or lose value. So money market funds, I've spoken about money market funds and I'll leave a link. Like I said, I have even come up with a list of some of the best money market funds in Kenya. Again, I'll leave a link in the description. So make sure you watch that video. Simply funds that focus so much on investing in short-term debt securities. When I say debt securities, I mean, the treasury bills, certificate of deposits, commercial papers, and such kind of investments. So basically what they do is that they do not invest in aggressive, high-risk investment options, but they go for these debt securities that are safer for people who just want to, maybe save their money. Instead of saving your money in a bank, you want to put it in a money market fund. So the interest rates or the rate of return is not as good or it's not as much, but your principal amount or your money or your investment is much safer. So yes, that's what a money market fund is. In Kenya, they invest in all manner of things, but like I said, they don't go into any aggressive investment. The interest rates fall between 4% to up to 10% sometimes, depending on the asset management company that you're using. So the second one, which is also very popular, is what we call the equity fund. So equity fund is just basically investing in equities or investing in shares or stock. Equity funds tend to invest in more aggressive, I would say, investment options, which are just shares basically. These are publicly listed shares. These are the ones you will find in the Nairobi Stock Exchange. These are the companies you will find trading publicly in Kenya. So if you want to invest in them, they're more aggressive, they give higher returns, and they're usually for medium to long-term goals. So you don't want to get into the market like a trader basically. You want to invest for the long term if you want to realize some good and superior results. So they're more superior, they're more premium, and they give better returns. But again, they're very aggressive, and that means there's a lot of risk when it comes to equity funds. So equity funds focuses on investing on such companies, on companies that are publicly listed in the Nairobi Stock Exchange if we're talking about Kenya. Then we have the fixed income funds. So these are the funds that focuses more on treasury bills, treasury bonds, corporate bonds, banknotes. They focus on the debt securities, but they aim at giving you some income from it, some income that is more regular, some income that is more sustainable over a period of time. So they're not as risky, they're not as aggressive, they focus on these debt securities, but they tend to be focused on giving you some income. So even if they do invest in other vehicles that are not bonds or bills, they make sure that they choose very conservative investments, and that in that case, therefore, you ensure that your principal amount is usually safe as you get some income from it. So if you want to sustain income over a period of time, this is the place to be. Income funds, I would say treasury bills, treasury bonds, all those kind of the securities are in this particular fund. So once again, they have a little bit conservative returns, not as good as the equity funds, because again, they're not as aggressive, but also not so low. So like I think around 5 to 6%, you will get a good income fund and you're able to make returns on your money as it grows. The growth, like I say, is not so aggressive, so you have to be ready for that and you have to accept that. Then we have what we call the target date funds, or some people call them pension funds. Again, target date funds are basically those funds that are focused on giving a certain return at a particular time. So they have like a target date. So most of the time, they're looking at your retirement time. For example, if you invest when you're 30, for example, they forecast that you're going to retire at, let's say, 65 or at 70. So they have that target in mind and they look at the returns of the market. Most of the time they invest in the stock market, in the equity market, but they mix them up with a bit of debt securities like bonds, for example. So the investment manager will decide how they do the mix up and how the diversification or asset allocation is done. But what you should know is that they are targeted at a particular date, giving you returns at a particular date. And again, they move with time. So if you're 30, they could say, for example, the one major rule that people use is that you take your age minus 100, and then you invest your age in bonds or something more conservative, and you invest the remainder, which is 70, for example, in stocks. So they kind of find a way in which they balance it to target a particular date with that fund in mind. It means that these funds are usually rebalanced by the asset manager. So depending on your age, depending on how time progresses, they rebalance that fund, they rebalance the asset allocation to match the allocation that was first decided upon by the investment manager or by the fund. So yes, these are what we call the target date funds. Some people call them pension funds. It doesn't matter. What matters is what they do and the returns they come with. And finally, we have what we call the balanced fund. Balanced fund is simply a mixture. So they mix investments in equities, they mix them with bonds and bills and all those debt securities. It's a mixture of everything. So they try and balance it based on what you want, based on your nature of investing, based on your strategy, based on your objectives and your goals. Again, that's something you agree with your financial advisor or the asset management company or whoever it is that's guiding you through the process. So like I say, these are some of the types of mutual funds we have. I will do a video on how to invest in these mutual funds. I've done one on money market funds. I've done one on investing in shares in Kenya. So maybe I need to look at, how do you access these target date funds and, balanced funds and all that. Otherwise, guys, I don't want to make this video long. I want it to be educational, short, and direct to the point. So we have looked at the 4 types of mutual funds in Kenya. You choose where you want to go to. You look at the risk level, the rate of return, and liquidity, and all those factors. Again, I've done a video on the kind of things you should look into before you decide to invest. So once again, I say that investing is very unique to each and every individual. So make sure you get someone who can actually guide you through that process and attune everything that you do with your objectives and your goals. Thank you guys. Until next time, peace out.